Home prices are officially falling. Between June and July of 2022, home prices fell for the first time in 3 years, month over month. And this was the biggest month over month drop in home prices since, get this, 2011, when we were coming out of the Great Recession. Between June and July of 2022, we saw home prices fall by 0.77%. This is a new report that just came out by Black Knight. And that might not seem like a huge number. Home prices fell by less than 1%. What's the big deal? Well, that 0.77% figure month over month comes at a time where June and July are typically the hottest months in the real estate market because kids are out of school, people want to move out, the summer weather is nice, so people want to move during those times. So typically during these summer months, you see some of the biggest booms in home prices because that's when demand is the highest. But on top of that, this 0.77% decline month over month in home prices is the biggest month over month decline since we were coming out of the Great Recession, which started in 2008. So this is something that you want to be paying attention to. And I have some interesting data on this because between June and July, typically, during those months, you see on average a 0.4% rise in home prices. So many people were expecting growth in home prices because that's what's normal during this time of year, but instead we did not grow. It actually fell. And Black Knight gave out some interesting quotes and responses to this. So the vice president of the research and strategy came out and said, quote, "We've been advising for quite some time that the dynamic between interest rates, housing inventory, and home prices were unaffordable and untenable from an affordability perspective, and something had to give." Essentially, we are facing a crisis where home prices are so high. On top of that, we have such a low inventory of homes. On top of that, mortgage rates are going up so fast. We are double mortgage rates today where we were in the beginning part of the year. And so if you have to borrow more money and you have to borrow this more money at a higher interest rate, it is going to make it harder for people to buy homes, and that's causing the affordability crisis. And on top of that, we don't have a big inventory of homes, making it even more difficult. And then they go on to say that we are seeing this something give happen right now, with July's data providing clear evidence of a significant inflection point in the market, saying that this is a turning point in the housing market and the further price corrections are likely on the horizon as we move into what are typically more neutral seasonal months for the housing market. Essentially what he's saying is that now as we get closer to the winter time, these are more seasonal months, more down months in the housing market, and that could provide more downward pressure in the housing market. Now let's talk about actually which markets are seeing the declines, because you're not seeing the declines everywhere. You are seeing them more locally right now, but it is now becoming a little bit more popular, more common, just because of how much declines are happening. Now, we did cover this in Market Briefs. If you haven't joined Market Briefs yet, I highly recommend you doing that because Market Briefs is a completely free resource that I created where every day my team is breaking down what's happening in things like the real estate market, the stock market, crypto, inflation, and the global economy, and we break it down into a fun, easy to read and witty email. Even if you don't have a financial background, you are going to understand everything that's happening in the markets. It is a quick email, and the best part is it's completely free. So if you have not joined Market Briefs yet, you should join. I promise you are going to love it. So I'll put the link for you down in the description below. That way you can join Market Briefs. And so the report goes on talking about which markets are seeing some of the steepest declines, and let me just go over them. San Jose, California saw the largest home price decline, with home prices now down 10% in just the last number of months. Seattle's down about 7.7%. San Francisco's down 7.4%. San Diego down 5.6%. LA down 4.3%. And Denver down 4.2%. So a lot of these are in the West Coast. We've already been hearing about people moving out of places like California. There's been a lot of people moving out, so that could partially be contributing to that. But those are also some of the places that saw some of the biggest booms in home prices. Now, one thing that you do want to be aware of is that certain pockets will see a bigger correction than others. Like places that saw some of the biggest booms have more ability to see more of a bust, but also the places where people are moving away from or don't want to be, where there's less demand, those have more variability in prices, because in certain pockets where there's less demand, if home prices start to go down, sellers are going to have a tougher time getting someone to buy the home because there's just not enough demand. The price of anything, whether it's real estate or stocks, or it doesn't really matter, depends on supply, on demand. When you have a lot of supply and no one wanting to buy the stuff, now the sellers are competing against each other to sell their product. In this case, the housing market, which means that they would have to cut their prices. When you have buyers all competing against a few homes for sale, like we have been seeing happen for the last couple of years, that's what pushes home prices up, because now the buyers are competing against each other, creating bidding wars, bidding up the prices of homes. And so what's been happening now is we've been seeing buyers start to go away, or at least take a pause, while sellers are slowly starting to inch upwards. I've made a number of videos talking about how the markets have been changing because of the higher mortgage rates and all of that stuff. So if you want to see more of that, just check out some of the other videos on my channel. I'll also link some for you in the description. But now where we are today, it's starting to feel the effects through the housing market, because now people are looking at these higher mortgage rates, where now the 30-year mortgage rate is hovering around 6% a year. Whereas a year ago, you could get a mortgage for under 3% a year. I mean, 2.5% in some instances. So more than double what mortgage rates were just 12 months ago, while home prices are up in some instances more than 20%. So you're borrowing 20% more money and you're paying more than double the mortgage rate than you could have just a year ago, is making it much more expensive for people to go out and buy a home. And naturally, when wages don't keep up, because over the last year, home prices are still 14.3% higher year over year than last year. And so if your wages haven't gone up by 14%, then the higher home prices are growing faster than your income. While at the same time, the cost to borrow money is also growing significantly faster than your income, because most people don't get a 100% raise. So people are paying more to borrow the money, they're paying more money to buy the home, and all these things have a cost. And if your income is not increasing with the cost, it makes it less affordable to be able to actually buy the home. And this is the situation that we're dealing with. And now the next question is, well, when is it gonna end and how bad is it gonna be? And this is where I do have other videos, so I'm not going to do a full analysis, where this is not 2008, because we don't have the same ninja loans and subprime mortgages. We don't have all those same factors that we did prior to the 2008 crash. However, we have much other economic factors that could trigger a slowdown in the housing market. What are those economic factors? Inflation and the economic slowdown. Now, the real indicator that you want to pay attention to, we talk about this in market briefs, I talk about this on my YouTube channel, is the Federal Reserve Bank. Because right now, today, the Federal Reserve Bank is working to raise interest rates to do one thing: fight inflation. And so if inflation is high, the Federal Reserve Bank is going to continue to raise interest rates. That's at least what they're saying right now. So if the Federal Reserve Bank is going to continue to raise interest rates, that is going to affect how mortgage rates are being conducted, because if interest rates go up, mortgage rates are also going to go up. If mortgage rates go up, housing affordability goes down. If housing affordability goes down, less people want to buy homes. If less people want to buy homes, now you have a smaller demand with a supply that is now, in theory, that's increasing. And so those are the factors that you want to pay attention to, because if demand continues to go down because the Federal Reserve Bank keeps raising interest rates, well, that is going to affect the housing market. And some of the best ways to kind of envision this is just to think about extreme scenarios. That way you can kind of break it down into little pieces. Because if mortgage rates were to double tomorrow, if mortgage rates went from 6% to 12% tomorrow, what would happen to the housing market? Well, the housing market would crash, because people would not be able to afford the same homes at the same prices today. Home prices would have to come down if sellers want to be able to sell their homes at a 12% mortgage rate. And so now you can think, well, if mortgage rates went up to 7%, 8%, 6.5%, how would that affect the housing market? It would affect it because Some people would have to walk away from buying homes because they just wouldn't be able to afford it. So these are the types of thought process that you want to understand, of just understanding how the different factors of what's happening in the markets can affect things like the housing market. Just like that, if the Federal Reserve Bank changes their mind, because maybe unemployment becomes a bigger issue. Maybe the economy starts to slow down more and they say, you know what, we're not going to keep raising interest rates anymore. We might even start cutting interest rates. How would that affect the housing market? Again, think about extremes. If mortgage rates went from 6% down to 3% tomorrow, how would that affect housing prices? Well, it would create another housing boom, because now all of a sudden everyone's going to say, I don't want to miss this opportunity to get a mortgage at such a cheap rate, so I'm going to go buy a home as fast as I can. That would push more buyers into the market, and that would push home prices higher. So these are the types of things that you want to understand, which is why you want to be paying attention to the Federal Reserve Bank. I'll be keeping you updated on my channel. If you haven't joined Market Briefs yet, you should do that.
If you enjoyed this video and you want to see why we might be entering a once-in-a-lifetime opportunity to build wealth and what you can do to capitalize on it, I already made a video covering it, and you can watch it by clicking that button right over there. Thank you for watching, and as always, keep hustling. When the 2020 pandemic happened, that was when the stock market and cryptocurrency was the biggest opportunity. Next time,